So as we quickly move towards the second half of 2023, the economy is facing a number of challenges. Now, inflation has been on the rise. Now, with the latest CPI data revealing that prices rose 6% in February 2023 compared to the same month of the previous year, well above what the new Fed funds target rate of 5% is. The Federal Reserve has been working to combat inflation by increasing the Fed funds rate throughout 2022, but it remains to be seen if this is going to be enough to bring inflation down into 2023. Now, one of the challenges facing the Fed was the collapse of that Silicon Valley Bank and Signature Bank, which complicates the task of managing the macro economy. Now, the Fed must not only deal with inflation and boost economic activity when the economy eventually slides into a recession, but also ensure financial stability when banks fail and prevent bank runs throughout our entire country. Now, the combination of fractional reserve banking, easy money, and FDIC depositor insurance has created a moral hazard that promotes risky bank lending. And when a rumor of a bank's shaky financial condition gains traction, a run unfolds, revealing tenuous liquidity situations and weak balance sheets. Now, the Fed is also facing the challenge of increasing unemployment in the financial sector and high tech, but it also has to be benefited with the Fed's easy money policies since the Great Recession of 2008. Now, recently, Goldman Sachs announced layoffs of around 4,000 employees and cut bonuses, which could be a forerunner to the 2023's Wall Street downsizing, leading to higher unemployment in canyons of lower Manhattan and soon the rest of the country. Now, one of the best indicators of an impending recession is an inverted yield curve, particularly the difference between the 10-year Treasury note and the three-month T-bill. Now, the curve inverted at the end of October 2022, and historically, when a short-term rate rises above the long-term rate, a recession begins about a year later. However, there are exceptions to every rule, and when the yield curve inverted back in 1998, a recession did not follow until the curve inverted again in 2000 when the Fed tightened the credit to deal with the dot-com bubble. Now, the yield curve inverted again in March of 2019 when the Fed began to raise the Fed funds rate in response to what was perceived to be an overheating of the economy and robust financial markets. Now, the Fed then pivoted and the yield curve went positive after then President Trump criticized the Fed for raising interest rates before the 2020 election. Now, this is one of many episodes in history where the president making his views known to the independent Federal Reserve, which usually responds to the president's wishes going into an election year. Now, the massive monetary stimulus of 2020 to deal with the economy's implosion because of the COVID-19 lockdown came home to roost last year in 2022. Now, the Fed's unprecedented increase in the balance sheet from 3.8 trillion in early 2020 to 7.1 trillion by the end of that year provided the fuel to raise prices across the board. With M2 declining in recent months and the Fed continuing to shrink its balance sheet, effectively withdrawing liquidity from the economy, what effect will this have on prices, unemployment, and GDP? It is clear that the economy is facing a number of challenges as we move into this second half of 2023. Now, the Fed must work to combat inflation while also ensuring financial stability and preventing those bank runs. Now, the yield curve inversion and the potential for a recession add to the uncertainty, as does the increasing unemployment in the financial sector and high tech. Now, it remains to be seen how these challenges will be addressed further. Now, my name is Rock Daniels, the Blue